Welcome to the case study series in Business and Government Relations by Skilled MBA. Didi's United States IPO marked a significant milestone in global tech investment. However, it was swiftly followed by regulatory backlash from the Chinese government, citing concerns over data security. This case highlights the growing geopolitical tensions between market expansion and national regulatory priorities. Didi's experience underscores the complexities of international investment, as the company navigated the delicate balance between accessing global capital and complying with domestic oversight, ultimately impacting its market strategy and investor confidence. Didi Global Inc. achieved market domination in China, boasting over 550 million users and controlling 90% of the ride-hailing market by 2021. Through aggressive strategies, it outcompeted Uber domestically. This success attracted significant investment, notably from SoftBank's Vision Fund, which propelled its rapid expansion and solidified its market leadership. Didi's pre-IPO growth was impressive, expanding into 15 countries with 493 million active users and $21.6 billion in revenue by 2020. On June 30, 2021, Didi debuted on the New York Stock Exchange, opening at $16.65 per share, achieving a $67 billion market valuation. The initial public offering raised $4.4 billion, signaling strong investor confidence in Chinese tech. Almost immediately after Didi's record-setting U.S IPO, Chinese regulators launched a surprise data security investigation. Servers were seized, mobile app downloads were suspended, and executives faced intense questioning. For investors, the move signaled a dramatic reminder. Cross-border listings can trigger rapid policy shifts when national security, especially data sovereignty, is at stake. For Didi, the crackdown reshaped its growth narrative overnight, forcing a pivot from global expansion to regulatory damage control. As you watch this case unfold, consider the delicate balance between accessing foreign capital markets and maintaining compliance at home. In today's geopolitical climate, regulatory risk can materialize faster than any market forecast. On July 2, 2021, China's Cyberspace Administration ordered the removal of the Didi app from app stores, halting new user registrations. By July 4th, a cybersecurity review was announced, citing illegal data collection, causing Didi's stock to plummet by 25%. On July 16th, 7 government agencies raided Didi's offices, seizing computers and documentation. Didi's decision to proceed with its initial public offering despite the Cyberspace Administration's warning highlights regulatory defiance. The company acknowledged antitrust risks in its prospectus, but failed to disclose the specific cybersecurity concerns raised by the Cyberspace Administration of China. This omission played a significant role in the subsequent regulatory crackdown. Didi's data, including mapping and transport patterns, faced United States regulatory scrutiny post-IPO, raising national security concerns. Ride-hailing platforms were reclassified as critical infrastructure under China's cybersecurity laws. Amid deteriorating United States-China relations, new regulations mandated Chinese companies to secure government approval before foreign listings, intensifying geopolitical tensions. Didi's IPO debacle led to significant financial and reputational damage. The company's market value plummeted, eroding investor confidence. Regulatory scrutiny intensified, impacting Didi's operations and public image. The fallout highlighted the risks of geopolitical tensions and regulatory environments on global business strategies, emphasizing the need for robust compliance and risk management frameworks. SoftBank's Vision Fund held a 20.1% stake in Didi, making it the largest investor. The initial investment totaled $11.8 billion. By December 2021, SoftBank faced over $4 billion in paper losses due to Didi's valuation collapse following regulatory scrutiny. In July 2022, Didi faced a $1.2 billion fine for cybersecurity and data law violations. Consequently, Didi was forced to delist from the New York Stock Exchange. opting for a Hong Kong listing. Additionally, Didi had to restructure its data operations, ensuring all Chinese user data remained on domestic servers. SoftBank, as Didi's largest investor, faces tough choices. They could sell shares at a loss, redirect future investments away from Chinese tech, or focus on companies with strong regulatory compliance. Alternatively, they might write down the investment or wait for a potential recovery, balancing risk and opportunity in a volatile market. Didi's regulatory crisis underscores the critical importance of regulatory compliance, geopolitical risk assessment, and full disclosure. Investors should prioritize these over rapid market entry. Data security, due diligence is essential to safeguard investments and prevent significant losses. Ignoring these factors can lead to catastrophic financial consequences, as evidenced by the billions lost in shareholder value. The Didi regulatory crisis led to a $1.5 trillion loss in market value for Chinese tech stocks. In the second half of 2021, 35% of planned United States initial public offerings by Chinese firms were canceled. Additionally, 90% of global institutional investors reported heightened scrutiny of Chinese tech investments, reflecting increased caution in the sector. Navigating cross-border tech investments demands enhanced due diligence. Investors should verify compliance in both origin and destination markets, focusing on data security. Stakeholder mapping is crucial to identify regulatory bodies and approval pathways. Transparency protocols are essential, requiring clear disclosure frameworks and prioritizing communication with investors about potential risks. Didi has navigated a complex regulatory landscape, delisting from the New York Stock Exchange in June 2022 to align with Chinese regulations. The company is now prioritizing domestic operations and fostering stronger ties with Chinese regulators. However, its international expansion plans are still unclear, reflecting a cautious approach in the current regulatory environment. Skilled MBA transforms global business challenges into strategic learning opportunities. Our case studies offer practical insights for business students and professionals, enhancing their understanding of real-world scenarios. For more information, visit our website at https://skilledmba.com or contact us directly at support@skilledmba.com. /91 87553 Thank you for exploring real-world global business challenges with Skilled MBA. We're here to help you understand the evolving landscape where business, regulation, and geopolitics intersect.